We have come to a pivotal moment in the economy right now. And if history is any guide, you better get your stuff in order fast. You came here for the truth, so let me unveil that for you. Today, we're going to look at a few factors which are all interconnected. The first thing I want to touch on is interest rates. Interest rates are what you should be paying attention to on a regular basis. Not just the interest rates that you've got to deal with, your credit card, your mortgage, and so on. No, we need to be looking at the broader picture. What's happening with all the central banks around the world? What are they doing? That, of course, connects in with number two, and that is inflation. Inflation is picking up all over the place today. And of course, we have number three, and that is house prices. House prices have gone up considerably in so many areas, and people are finding it completely unaffordable. Let's get into it right away. Your favorite and mine, Janet Yellen, had some interesting things to say. Now, I want to be very clear about what she said, and it's something that can be taken out of context. So let's look at it. Yellen says higher interest rates would be a plus for the US and the Fed. Treasury Secretary speaks in an interview after the G7 summit. Yellen will not give up on the $4 trillion spending plan. They want the maximum amount, right? So actually further down, I have it right here. If we ended up with a slightly higher interest rate environment, it would actually be a plus for society's point of view and the Fed's point of view. Can you believe that? Actually suggesting that higher interest rates would help. So while we have certain countries going into the negative, you have the Treasury Secretary of the US suggesting a little bit higher in the interest rates would be good. Are they starting to talk about this simply because this is where we're heading? And I've said it before, and I want to make it clear again. If you look at the trend here in which the cycles are going always going through, and basically we had a very high interest rate, 20%. And then the next time around, let's say it was 7%, and then 5%, and then 2.5% for the last cycle. This time around, I assume they cannot get higher than 0.75 to 1.0 without completely crushing the economy. This is what I think. We'll see what happens. That's speculation, and that's just simple charting of what I've seen before. They do talk about price inflation and so on. There are some other quotes in here. We've been fighting inflation that's too low and interest rates that are too low now for a decade. We want them to go back to a normal interest rate environment. And if this helps a little bit to alleviate things, then it's not a bad thing. It's a good thing. What are we talking about right now? This seems like the complete opposite of what they've said previously. Not just Janet Yellen, of course, but just look around. There was a few other things in here about the packages and so on, but I think it's pretty clear that right now, as far as I'm concerned, they're kind of warning for what we're about to see, because this is not the first instance of something similar being said. Then we have this. Inflation levels are going to keep rising. That's going to raise some questions. Is the Fed going to make a policy adjustment at an FOMC meeting or perhaps at Jackson Hole? So we are going to look at this information coming out in the near future, and some say, maybe September they'll start talking about it because over the summer inflation will pick up. But around that September timeframe, I've mentioned it before, is extremely key, because a lot of the different analysts and, somewhat we've heard this from the Fed, that inflation will pick up around the summer, and then as it goes into the later part of the summer, that will start to slow down. Because remember, a lot of this inflation that they're using, not real inflation, of course, but their inflation rate is year-over-year metrics. So when you see that, of course, if there was extremely low inflation or deflation during a period, anything is going to look higher than that. So if we do see it go through this pattern, then perhaps the Federal Reserve might say, well, inflation is calming down, so we don't have to necessarily, take our foot off the gas at full speed. We'll see. We're happy to do it because we've got plenty of money burning a hole on our pocket, but those levels of inflation are rising, perhaps a little more aggressive than the Fed expected. So of course, you look at the details and it makes it very clear. Again, just more information coming out regarding the exact same thing. Employment miss likely to keep the Fed patient and support the cyclical trade. This is what we're dealing with right now at this time. What does this mean? It means that if the statistics show what they have been showing for the last little while, the Federal Reserve is going to say, okay, don't worry about it. We're just going to leave it the way it is, and statistics will remain how they are. Let's all keep the same game going. That's what they're telling us. Whether or not it's true, who knows? I'm just simply putting out what they say, the data, and what we can expect. Now, this right here is, of course, Robert Shiller, and he's got his own Case-Shiller index. He's been putting out information for a very long time, and I found it interesting what he said. He's talking about the prices of homes. He's talking about inflation. We have a lot of upward momentum right now, so waiting a year probably won't bring house prices down. If you go out 3 or 5 years, I could imagine that the prices, be substantially lower than they are now, and maybe that's a good thing, not from a standpoint of a homeowner, but it's from the standpoint of a prospective homeowner. It's a good thing. If we have more houses, we're better off. And that's so true, because people today, they're already buying their homes, they're paying down the mortgages, and they're seeing the equity rise. They're happy. Their house has doubled in the past several years. They're living it up. They're using that equity. They're borrowing from the home and they're buying stocks with it. They're borrowing to do renovations. They're doing all kinds of things. But of course, this isn't good for those who aren't in the market yet. And there's constantly new people trying to get into the market. So those people, unfortunately, are being left out time and time again as the prices increase. Now, I wanted to just show you this, but really, if you have the time, definitely check out this article. It's out of Bloomberg and it's an interactive article. So you can see building a home in the US has never been more expensive. Copper, cement and concrete, lumber prices showing you how they've all increased over the last few years. But this is it right here. It's probably too small for you to read on the screen, but essentially what you're seeing is the home, the foundation, the lumber, all of these different things, and you can click on it and it shows you this little image, and then on the left-hand side, it's giving you a graph to give you an idea of how high the price has gone over this period. And there's always going to be increases every year. For example, 2019, it's $29,000 for the lumber. Then you move into the next year, $32,000, but now $104,000. And it explains, what exactly they're referring to and so on. And there's definitely fine print there. But I just wanted to show you this so you can get some insight as to each of the main materials that go into it, including the appliances, the finishing, and so on. I just thought it was really interesting. Definitely check out the link in the description under the sources. I think it's really key to understand. And now for everybody's favorite part of the show, the Money GPS Insights. Number 1, if inflation increases, interest rates are going to have to in order to stifle it. That's just the way it goes. Number 2, we have seen the markets right now, the stocks have pulled all of the growth from the future into the current prices. And that's because of these low interest rates, in part because of these low interest rates. So you've got to be aware of that. And last, number 3, we need to look at the fact that, to me, it's pretty obvious we've got slower growth ahead. And that's just a simple matter of fact. When you have run on fumes, on stimulus, you cannot keep this going forever. 35% of small and medium businesses are at risk during the summer of 2021. That's just showing you they're at risk of being closed permanently by the end of the summer. For different reasons, of course, but this to me was quite shocking. And of course, it's a sample, it's a survey, but it does give us insight. I've got a few charts to show you right now. Morgan Stanley put these out, and essentially the long and short of it is that many of their different indicators have triggered a sell signal. Does that mean sell everything? Does that mean run for the hills? No, but it's just showing overvaluation, okay? So looking at this, it's basically just giving you some insight. If you want to read it further, and I'm not going to beat a dead horse on this, but there are several, okay? So you could look at the full house sell signal, our combined market timing indicator. You look through here, just comparing this. It's been negative for cyclicals, as they say on the left-hand side. On the right-hand side, even in 2017, when equity markets had risen, you go through and you start to realize that there are so many different reasons why things are very lofty today. So what does that mean in terms of the prices? Hey, it's anyone's best guess, but people can't even deal with a sideways market. Okay, that would crush some people in the way that they do their business. So this is not looking healthy, that's for sure. The China credit impulse is what they're talking about here, particularly on the left-hand side. And I've talked about this, and I've shown you that this has actually gone into the negative. It's so key, it's so important. I've warned about it, over the last little while, and I think this is something that people should be paying attention to because it gives you insight as to what's going to happen. And that's very difficult to do, to get that insight. Just comparing to what we see in Europe on the right-hand side as well, that, I think it's unbelievable. The whole situation is unbelievable to take from the future to pull to the present on low interest rates. And at the same time, you've got inflation, price inflation picking up, and people are getting crushed. Look at the price of lumber, for instance, where it's gone. Now that's come down. Lumber gauge finally slips in further sign boom may be easing. But how far does it come down? And if all the futures come down, if these commodities come down, will the prices that consumers pay come down as well? I'm not so sure about that. Look, if you want to get in touch with me, if you want to get my email 5 days a week, this information here is obviously being censored. It's being sheltered. It's being controlled by this platform that we are working on right now. But if you get on the emails, you're going to be able to see it every single day. I will email you the video, and it will basically end up in your email inbox. And if for no other reason, it's a backup, okay? People, we need to get smart. And finally, after all these years, I'm doing it. So if you sign up, you're going to be one of approximately 4,000 people that is on this list right now. And I want to build the list to have as many people as I possibly can. Right now, it's just a daily email with the video in it. But at some point in the future, it's going to have original content, a lot of useful information. So definitely check it out. If you found the video informative, hit that thumbs up button. And if you haven't seen this interview already, you definitely want to check it out. Profit Market broke down so many technical indicators. It is a fantastic one that he just simply explains it all much better than I ever could. Check it out.